Hey everyone, welcome back to the channel. I am here with John Mulvihill. It's been a while, John. How you been, man?
Not bad. Yeah. A couple of years since we were on here talking about our Canadian bank ETFs. So yeah, I
Yeah,
think we've been
I
good.
just checked like last night. It's been like a year and a half or something like that, 2023. So it's great to have you back because you launched a very interesting ETF. That has to do with preferred shares of split funds. Very, very interesting. It's had a lot of attention in the community because everyone's always looking for like a de facto cash parking more safety ETF. And obviously, we know that there's some competition. Both Brompton and Quadravest have their own, but yours is actually very unique. So let's go through it together. The first question I have: why did you decide to launch this ETF?
Yeah, I think it really goes back to the history of Mulvihill. So we actually manage the oldest split share trading on the TSX today, our Premium Income Corp. So it's an area that we know a ton about. Premium Income Corp just finished its 28-year track record last October. So it's been a very sort of, you know, great area for us to be a part of. We were one of the founders of launching split corps, and we've managed them for almost 3 decades. So when you manage something for that long, you definitely you learn the intricacies of all of the ins and outs of these. And we think that by launching what we think is a fairly unique product in this space, it really allows us to use our expertise and our experience to find preferreds in the split corp universe that are trading at attractive yields or mispriced, and it really lends itself to the active management that we want to bring in this product. So, we are always in our firm looking for lower risk ways to provide enhanced yield strategies, and the split preferred shares have a long history of doing that, and we think by adding a couple of features to our ETF that we'll talk about that it really sort of changes the risk return profile in a meaningful way. So
Awesome. Yeah, in case my audience doesn't know what the premium, that's the stock symbol is PIC, and that focuses on the Canadian banks. It's like you said, the oldest Canadian bank split share fund that's been around for a very long time. So today we're going to focus on SPFD. I always have a little bit of trouble with these stock tickers, but I always think of like sunscreen, and I've mastered it. It's so easy when you think of that.
yeah, the
SPFD.
SPF, yeah.
So it's the Mulvihill Enhanced. So whenever I see enhanced, my ears always perk up because it typically means a little bit of leverage, which is great. Split preferred share ETF. So obviously this is going to focus more on the preferred shares of the split funds, which we all know is like very low volatility because they don't participate in the portfolio. That goes the leverage participation in the portfolio goes to the Class A share. So they're quite boring. They're quite steady. They're typically about 5, 6, 7% yield. And this one has a yield of 10%. That's because there's leverage to this, which
Yeah.
we'll discuss. But first, let me just say that this one started at about December 10th, I believe, trading, or
Yep.
that's the earliest date here. And you've actually transitioned a past ETF, a healthcare ETF, to
Yep.
SPFD. So why did you do that? Is it just easier from an administrative standpoint instead of creating a new ETF, you just transition them? Because I know other
Yeah,
providers do it.
it's cheaper to just take a an existing one that we found in the healthcare space. Obviously, there's just a ton of healthcare ETFs, and it was very competitive to sort of add any sort of differentiating factor. And so we thought we had a real opportunity here to again use our expertise in the split share market, and add a couple of features that could really differentiate ourselves and only two other ETFs in this space. So, we're excited to
Yeah.
be here, and it's right in our wheelhouse.
Yeah, that's great. And we're going to look at the fact sheet because I find this is pretty much has a lot of great information in case my audience is curious. It's right here. You just click on that. You could check it out on Mulvihill's website whenever you want. But let's go through it here. So we see obviously the first thing I guess we could talk about since it's right here is the leverage. But first, let's see what actually is inside of this ETF. So if we scroll down, we will actually see the portfolio holdings here. And it's pretty much what I expected. You have really some of the top preferred shares from Brompton and Quadrivest, like the Canadian Bank Corp, North American Financial, which is FTN. You have DFN and the Split Corp 2 here. Here's Financial 15.
Yep.
I'm sorry, this is FFN. This is FTN.
Yep.
Canadian Life Co's, and then there's PIC, like
Okay.
what you talked about at the beginning. Brompton one. So it seems to be a combination. Is this like market cap weighted? Is this actively managed? How are you choosing which split share funds preferred are going in here?
Yeah, so what we did was we went out and we engaged Index One, which is an index provider, an independent index provider, to create an index for us that we could show the historical risk and the historical returns of the split preferred share universe. And so what we wanted to focus on was really the largest and biggest preferreds in the market. So the way that they have constructed the index is every quarter they go and look at the top 10 largest split preferreds and they equally weight them at 10% weight each. And
Okay.
that is the index, and it gets rebalanced every quarter. So really, when you're looking at this, it has a real tilt towards the biggest and the largest of the split preferred shares. And we feel like that's important for a number of reasons. Liquidity being one, in
Yeah.
terms of being able to trade in and out of them. They've also had the most consistent and best performance we found over time. So we do really want to tilt the portfolio towards the largest ones. Now, having said that, we don't just follow the index that Index One created for us. We do actively manage it. So
Okay.
we will hold weights, as you can see, above the 10% weight that they would be in the benchmark in order to, some may trade at less of a premium right now or may trade at a higher yield. Some may have monthly distributions or quarterly distributions. There's a bunch of different decisions we want to look at when we're adding these into the portfolio. So, we're looking for large, we're looking for liquid, we're looking for higher yield, and we're looking for, ones that aren't trading at astronomical premiums in this market. So,
That's very interesting, and I'm glad you brought that up because to me, one of the special things about these split share funds and closed-end funds in general is that discrepancy, right? The stock price versus the NAV. So, like you said, this is part of this active management where you guys are maybe going to tilt a little bit more to the prefs that are maybe trading at a discount or less of a premium. Have I heard that right? I really like that because that prevents me
there's
from
not a lot
doing,
of prefs trading at discounts.
I would assume not.
If any.
Yeah.
So they are all sort of trading at premiums. It may be a separate conversation, but I think they're trading at premiums for good reason, given that a lot of them just went through their rate reset
The reset, yeah.
at the time that sort of interest rates came higher. So, us, for example, we had to reset our Premium Income Corp preferred share in October of last year, just as interest rates were peaking. And, you have to keep these competitive to what people are getting from cash. And so
Yeah.
we had to increase the distributions on a lot of these prefs, as did Quadrivest, as did Brompton. And so the whole universe of these now have higher yields. And I think what is happening in the market today and why they're going to premiums is that the market is repricing these by taking the prices higher and bringing the yields down to be more in line with where interest rates have gone. So, although they trade at premiums, I think there's actually room for these to continue to trade at premiums and potentially higher premiums going forward.
Yeah, of
So,
course, because as interest rates go down, they get even more attractive because these reset typically
yep.
every five
And
years.
the
I've had
rates
this,
are fixed for the most part. So, yeah.
yeah, and I had this discussion also with Chris from Brompton as well. They said the same thing. When interest rates go up and these need to be reset, they got to be competitive so that the rates have been a lot higher, so the yields have been higher. And you see the yields. I really like that you did this, by the way, in the fact sheet. You actually put the yield. Of course, this is as of end of January, I believe, but the yield of
Yeah.
each one, and you could see that they're really high. They're pretty high, which is great.
Yeah.
So one thing I noticed is that you've also added, was very interesting, and I've gotten a lot of questions from the community. It's not just the pref shares. You added a little bit of Class A shares. So I see the E split. I recognize it right away. That's the Middlefield Enbridge one, which right now is actually trading at a really big discount. So I'm happy to see that one here.
Yeah.
You have a 10% holding, but there's also this one, the Premium Global Income Split, which is actually a new split share fund that you guys came out with. It's actually right here, the
Yeah.
Premium Global Income Split. That's a stock symbol PGIC. And if I look at maybe we could spend a minute or two on this one. But this
Yeah.
one seems very interesting because unlike many other split funds that focus on Canadian financials, this one seems to have a lot of stocks all over the world. So maybe you could talk about this one real quick here.
Yeah, very quickly. There's a couple of things that make this fund stand out. So this was another sort of corporate action for us last year where we merged a bunch of splits together into one. And
Okay.
so we merged them and we changed the mandate to Premium Global Income Corp. As the name suggests, it has more of a global focus. And we think this is really a theme in the market right now. When you look over the last 10 to 15 years, just how much US stocks have outperformed international. We think that there's a real opportunity at some point for that to really revert to the mean, if you will. And so, when we began to dive into global strategies, what really stood out to us was that we think investors believe that they're getting diversification by going global, but a lot of them just track the MSCI or use the MSCI World as their
Yeah.
benchmark, and it's 73% in US stocks. And a lot of that US allocation is to these highly valued technology companies, which has worked out great. But when it doesn't, it's not going to work out great. So we really wanted to create a truly sort of globally diversified split share product. So what we do is we hold more of a combination of Canada, US, and international.
Yeah.
So right now we're slightly more US, but I would say on average it's going to be sort of a third Canada, US, international in terms of the exposure. Um,
Interesting.
one other sort of aspect of this fund that is quite unique is that when we merged three of the splits together, the entity that survived, this PGIC, had a tax loss pool in it of $116 million. And what that allows us to do is to pay the distributions as return of capital. So
Rock.
a
Yeah.
real tax efficient yield. And so if you look at the Class A, I believe the yield on the first page is about 12.1%, and the yield on the pref is 7.5. So on sort of a tax deferred rock basis, it's very attractive way to sort of get global exposure in the portfolio.
Yeah, this is probably now the most diversified split share fund I've ever seen. So I mean, it has US, Canada, and international. So if people like split share funds and they really want that diversification, and this is not only this is dividend stocks. I recognize a lot of dividend stocks, but there's also some non-dividend stocks here as well, which gives you even more diversification. Things like Bombardier and other stuff. So
Yeah, for sure. Especially,
pretty
I mean,
cool.
even Chinese internet stocks. There's Alibaba's in there, JD.com.
Yeah.
We got
SAP Taiwan. Yeah, the
exactly.
so
So
still the big cap though, right? It's not like
yeah, we want to.
you're
Yeah, we keep it large by design.
okay.
Yep.
Awesome. Really cool. So that's has a little exposure in here as well, which is cool. Okay, perfect. So the
Just
funnest
on
part. Yeah, sorry, go ahead.
I think it's probably worth spending a couple seconds on
Yeah.
why the Class A shares are in the portfolio.
Yes.
So it's obviously there's the two other split shares in the market, split share ETFs in the market that you mentioned. So we wanted to do something that differentiated this product from what they were doing. One of them being adding significant amount of leverage to juice up the cash flow, which we'll talk about in a
Yeah.
minute. The other being having an allocation of up to 20% of the portfolio that could go into these Class A capital shares. And really what we're doing here is we're looking at for Class A shares that trade at big discounts to their NAV and have very high yield. So it allows us to bring the yield on the overall portfolio up, and it also allows for some capital appreciation potential as these start to begin to, potentially trade closer to NAV. And I think, as as the coverage on a lot of these prefs has gone up and the Class A NAVs have gone up, I think there's going to be a lot of potentially special distributions paid in this area to bring the NAVs on the Class A back down and sort of reset the leverage on them, which is what investors want. So, trading at discounts, I think there's going to be an opportunity for specials in here and very high yielding. And we own them in names like eSplit, where we like the underlying holdings. So,
Yeah. Well, I've heard a couple of great things I like. So the first thing I want to confirm in what you mentioned is maximum, you're only going to put 20%
yeah,
maximum. Doesn't mean it's going to be 20. Right now it's about 12, 13. But max, okay, so the mandate is maximum we could put is 20%. The 80% plus is going to be to the preferred. So that's the first thing I heard. Second thing I heard is that you're actively managing it to look for big discounts. And ENS is, which is the E-split, is a massive discount right now. And to me, that's really the special thing about the Class A shares. You hunt the discounted ones down, because when it gets closer to the redemption date, at which is typically every 5 years, it typically goes back up. So this is why you mentioned the potential for capital appreciation as well, but still the majority to the preferred shares.
And there's lots of opportunities. I mean, if you look at the Class A's, there's a ton of them trading at big
A
discounts right
lot.
now.
Yeah.
And there's really interesting. I think it's FFN that I believe its redemption date is the end of this year. So that's one that is going to should probably close the discount fairly quickly. So something
Yeah.
that we would look to add in the portfolio, as it probably trades closer to NAV by the time December rolls around. So
Yeah, I do a weekly report on split share fund premium discounts, and I think almost all of them are trading at crazy discounts here, or
yeah,
some more than others. So it's pretty incredible. So let's talk about this leverage. So this is very exciting because your competition, obviously, we're talking about SPLT and Pref. They have no leverage at all. They don't, and it's pretty much all preferred shares. So yours is different in two ways. What we talked about, the up to 20% the Class A shares trading at discounts. 50% leverage. So I was a bit surprised when I saw this, because typically the amount is 25 or 33. So tell me a little bit about the leverage and why you decided to put that.
yeah. So I think when we looked at what Index One provided us in terms of sort of the historical track record of split preferred universe and the yield, I might share a slide here if you don't mind.
Go ahead, right ahead.
Um, so yeah, when we looked at sort of the return, you can see that okay.
It's coming up. Yeah, I can see that now. Yeah.
So I'm gonna move down to to this one here. So when we looked at what the split preferred share index, and again, this index does not have leverage incorporated in it. So this is just
Okay.
pre-leveraged, what the split preferred universe has done. It returned 6.6% since the inception of the index in July of 2012 on an annualized basis, and it had volatility of 4.7%. So when we started lining that up versus the TSX preferred share index, which had an annualized return of 3.2% and 11.7% volatility, and the Canadian aggregate bond index, 2.3% return and 5% volatility, the light bulb sort of went off when we were like, wow, we actually have a sort of a group of securities here that have historical volatility that's lower than what you're getting from sort of the fixed income proxy in Canada. And so when you begin to think of areas that you want to use leverage, it's low volatility areas and consistent income in the portfolio. And so when we saw, and we've witnessed this in our own products, how low the volatility is in these, we really wanted to push that leverage as far as we were able to. And so historically on our Canadian bank fund, we're 25% leverage. It kind of offsets the drag in the option writing strategy in the up market. But what we wanted to do here was really take it as high as the regulators would let us, and that was 50%. And so, that's what we've been able to do. And it has a meaningful impact on the returns, and it increases the risk slightly, but a very meaningful impact on the overall return profile of the portfolio, allowing us to pay that 10% yield. So
Yeah, these charts are incredible. I mean, you could see how much better the split share fund prefs perform versus just regular Canadian preferred shares by a lot. I mean, we're talking 3.8 average return a year in the last 10 years to 6.8, but the volatility is less than half, which
yeah,
is absolutely incredible. So of course it makes sense that if the volatility is so low, let's put as much leverage as we can. And this is 50%. It's not like it's 100, like a 2x thing. This is
yeah,
50%. It's pretty, I would still say it's pretty modest. It's not an insane amount. Obviously it's more than 25, but you're putting it to a really stable, boring asset class, I would say, which a lot of people are
yeah.
really looking for. So what about, I'm just thinking of maybe questions people might have. 50%. Stuff like margin calls. How likely do you see a margin call, for example, if, I don't know, the market takes a dump. But the thing is that even if the market takes a dump, the preferred shares are pretty much protected. But let's say they go down 20% or something, which is, I would say, very rare. Would you be in
Yeah.
danger of a margin call or anything like that?
No, the way that we're looking at it right now is it takes a drawdown in the portfolio of about 28 to 30% for us to sort of trigger that level. And even then, it's not like we're pledging the whole portfolio as collateral at the moment. So we do have room to just pledge additional stuff in the portfolio. So I don't foresee that being an issue, particularly how these have traded over time. I mean, a 30% drawdown in the split preferred share universe is I mean, based off of this chart, non-existent, I would
Yeah.
say. So,
Yeah, it's
um,
very rare. Yeah, yeah.
yeah,
Okay. No, that
yeah,
makes sense. So, for who would you say this ETF is designed for? Is it someone who wants to really replace like a fixed income type
yeah.
of ETF, like a BMO ZAG, or like it says here, an aggregate? Is it for someone who wants to park cash maybe for 6 months, a year? Because I see it really still, even with the 50% leverage, as a low risk type of deal, something that could bring stability to maybe an equity portfolio. Who do you envision this ETF for?
Yeah, I think it's a bit of everything that you just mentioned. I'll kind of run through them one by one here, but I think in terms of preferred shares, like if you hold a preferred share ETF or you just own outright sort of preferreds on the banks or the telecos or whatever it may be, you have to really question what you're getting. So, you've been investing in that for low volatility and stable income. And, if you just look at the numbers here, what you're
Yeah,
actually getting is really low returns and volatility that's actually essentially in line with equities, right? So you're taking equity like risk and receiving really crappy returns. So first and foremost, I think if you do have exposure to preferreds, they had a pretty good year last year, as did split preferreds. I think this is a natural sort of switch for people that have that type of investment. Um, Taking it one step further, I have a lot of views on sort of fixed income that I probably don't need to share here, but
me
uh,
neither. Trust me, I've been pretty vocal and I'm not a fan.
yeah. So I don't think they have, and this is a bit, you know, broad, but I just don't understand what role they play in a portfolio right now.
Me
So
neither.
when I look at equity markets right now, and I think about what ultimately could bring down stocks, whether it's higher interest rates, deficits, resurging inflation, whatever it is that the equity markets seem to be sort of concerned with, is
Yeah.
also really bad for stock or for bonds. So what's the point on holding something that's not going to give you any upside, really, and it's also not going to provide that diversification or hedge when you need it in the portfolio, much like we saw in 2022. So
Yeah.
I question what role that has. Again, I mean, everybody knows how poorly they performed. I think the number that was on that slide is 2.3% per annum. That's pre-tax, pre-inflation. So you're looking at a negative after-tax real return from your fixed income over the last 12 years. So definitely as a fixed income substitute, I think that this could play a real role as an alternative income source in a portfolio. And even with the leverage that we're adding, it takes the volatility on sort of our product from 4.7 pre-leverage to 7% post-leverage. It's still not that
Still
much.
lower than
Still, yeah, like it's higher than fixed income, but it's also a lot higher return, and it's still fairly low in terms of other other risk profiles from different asset classes. So that is sort of the fixed income substitute. If you don't mind, I'm gonna share one more
Of
slide
course,
here,
go ahead.
just to touch on the ability to sort of use this as an equity replacement. So um, what you're looking at here is the same chart. So the blue line there is the Mulvihill Index 1 Split Preferred Share Index. The gray line is an assumption on what that index is with 50% leverage. And then it compares it with the TSX, right? And so what you're seeing is that as you leverage this up, you're actually getting performance that's equity-like with
Well,
volatility that's not equity-like.
yeah, I think
And
you're being
so
modest. It's beating the
it's
TSX. It's
it's
beating
beating. And
the.
so yeah, I think the broader point is that, as this bull market ages, as valuations are fairly high, This may not happen tomorrow, it may not happen next year. Who knows when it's going to happen? But it's definitely not the early innings of where we are. And I think this is a great way to maybe, take some equity exposure off the table and still have potentially equity-like returns, but with a lot more risk and downside protection built into the portfolio. So I was very excited when I saw this line up almost perfectly like
I
that.
could imagine. It's
Um,
absolutely incredible because
and it's
you're
it's funny.
getting.
It's actually, if you look, I was looking at it this morning. If
Mhm.
you look year to date, it's not a long time frame here. We're talking 6 weeks, but the TSX is up 3.6% as of yesterday, and SPFD is up 3.6% with less volatility. So it's essentially again tracking in a very short period of time what equities have done this year.
That's incredible. So you have equity type returns over the long term. This is kind of I really like these indexes where you go historical. So this is kind of simulating if SPFD was around for 10 plus years.
Yes.
You have Canadian equity type returns with less volatility.
Yep.
And we haven't even talked about another major point, the tax efficiency of the distribution. So this is another reason why I don't like fixed income. If you get a bond type ETF, you're getting the worst type of income, interest income or regular income.
Yeah.
What kind of, we know that preferreds typically give Canadian eligible dividend income. Class A shares typically give ROC and capital gains. So is that what we could expect in terms of tax breakdown for people holding this in a taxable account and non-registered?
Yeah, it's hard to say, but it will be some combination of return of capital and eligible dividends. That's what we've seen from our own split preferred shares. That's what we've seen from other split preferred share ETFs. So that is what the expectation is. Whether that's 50-50, 75-25 will depend year to year. But that is what we expect, and that's great news given that's much more tax efficient than what you're getting from interest income or from your fixed income portfolio. So it
Definitely. Yeah.
is
Double,
nice.
more tax efficient with more return. I mean, to me, it's a no-brainer. This is not you speak. This is my personal opinion. I think this is a fantastic
Yeah.
ETF to really get yourself low volatility, replace that fixed income in your portfolio. Why get destroyed and have like very terrible tax inefficient returns when you can get something like this? To me, it's a no-brainer. So,
Yeah.
thanks for the
Um,
slides, by the way. They're really
yeah.
helpful.
I do want to touch on one thing, which is the cash alternative. So I know
Yes.
you mentioned it as an alternative to cash. Um, I will just be very clear in that I don't think there is an alternative to cash. I think cash is cash, and anything that yields above cash is doing so because it's absorbing some additional risk.
Of
So
course.
I can't sit here and say that I think this is yielding 10% with the risk of cash because it's just not true. It does intentionally take on more risk. We want it to be a riskier play within what we believe is a lower volatility pocket of the market. But we can't go from 5, 6, 7 to 10% in our product and not expect that we're taking on additional risks because we are. So
Yeah. No,
just
I totally
say that
understand
to the
that.
audience. Yeah.
And for the record, the official risk rating is low to medium on this one on SPFD. This is an actively managed fund, so the management fee is 65 basis points, 0.65, which is pretty much in line with an actively managed covered call ETF. For example, this actually has a more yield than a lot of them on the on the market on the Canadian market.
Yeah.
So yeah, I think we talked about everything. And what I've been doing, and this is a suggestion for my audience members watching it, put it on your watch list and put it next to other low volatility assets. I've been watching it every day, and it's been, pretty much almost, it doesn't move that much, which is what I expect mostly with these prefs from the split share fund. So
Yeah.
to me, it looks, I'm going to keep watching it. It looks like it's doing its job. In terms of, do you have anything else to add, John? I have no further questions. I think we covered it in detail here, what this ETF's all about.
No, I think just, we're very excited about it. I think the uptake so far has been great. We're seeing trading come through every day, and it's pretty broad across systems, which is usually a good sign in terms of the longevity of the ETF. So, we are seeing it gain some traction here, and it's just 2 months in. And, we're very excited. We think, again, just to sort of reiterate, this is an area that we've lived and breathed for almost 3 decades. So we think we do have some expertise to provide active management in this space. And the, concept of the leverage is new to this space.
Yeah.
And I think the numbers, the historical numbers and the back tests speak for itself in terms of what we think it could achieve. So we're
Yeah,
very
really
excited.
cool.
Yeah.
Thanks for sharing those slides and preparing them for that. So I did ping my members to see if they have what are their top burning questions. I think we answered pretty much most of them. One was what is the AUM, and I feel you said it was about 11 million now,
Yeah, it's about
approximately.
12. It's about 12, and then that's pre-leverage, and then put the 50% leverage on
Well,
it. So
that's actually
yeah,
for 3 months, not even, it's pretty good. I
2 months.
know that typically once they pass 10 million AUM, the ETF is here to stay. So I'm
Yeah,
assuming it's going to grow quickly because it's a pretty cool
it
concept.
is, and we're getting a lot of inbounds and a lot of
Hmm.
questions and marketing it heavily. So I think it's it's been a great start, and a lot of great feedback so far. So yeah.
Okay. Yeah, we other questions were why did you include a small amount of Class A's? We already talked about that. What's the current leverage ratio? So when you say 50%, is it 50% or is it like up to
It's
50%? How
up
is
to 50, but again, sort of the theme that we're going with here is you know we want to be the high risk provider in this space, if that makes sense. So like we do want to run this at 50% leverage. So right now, I believe the leverage is in and around 45%. So it will, for the most part, be upwards of 50% at all times is what we're trying to achieve.
awesome? Awesome. Well, really appreciate your time, John. And if my audience has any questions, you could go on Mulvihill's website, go to contact us, and there's a form there. There's an email info@mulvihill.com. You guys could send John and his team your questions. But I think we pretty much got it all covered here. So if you don't have anything to add, John, I'm good. We could wrap up.
Perfect. Lovely.
All
Thanks
right.
everybody for your time. Yeah, it's great.
Thanks so much. I appreciate your time, and we'll talk again soon. Hopefully not in 2 years.
Yeah, that's right.
All right. Take care,
All
John.
right. Thanks, Adrian.